Garmin, ticker GRMN on the Nasdaq, the GPS navigation, aviation avionics, and wearable device company that survived the smartphone disruption that destroyed its competitors, generating $5.89 billion in revenue across 5 distinct segments.
Founded in 1989 in Olathe, Kansas, incorporated in Schaffhausen, Switzerland, 19,000 employees, operating margin of 27.5%, above peers. Free cash flow of $1.4 billion. Aviation revenues surpassed $1 billion for the first time in 2024.
Gary Burrell and Min Kao, 2 engineers from King Radio Corporation, founded Garmin in 1989 to commercialize GPS navigation. They went public on Nasdaq in 2000 as the consumer GPS market was just beginning, and captured the early leadership position in automotive navigation before smartphones existed.
By 2003, Garmin's GNS 530 and 430 navigation systems had become the most widely installed IFR navigation systems in general aviation cockpits, a market position they hold today, more than 20 years later.
By 2006, Garmin was the world's largest GPS device maker, having shipped more than 50 million units. Then the smartphone arrived, and the consumer auto GPS market that had built Garmin began to collapse.
The 2010 pivot away from consumer auto GPS toward multi-segment diversification is the central strategic event in Garmin's modern history. While Magellan and TomTom failed to adapt, Garmin invested in aviation, marine, fitness, and outdoor, each a niche where smartphones couldn't compete.
In 2016, the Forerunner 735 XT multisport wearable opened the premium endurance athlete segment. In 2021, factory-installed Garmin navigation systems appeared in BMW, Honda, and other global OEM vehicles, adding auto OEM as a 5th segment.
In 2024, Garmin launched the Fenix 8, its premium smartwatch at $1,000 or plus, while aviation revenues simultaneously crossed the $1 billion annual run rate milestone for the first time in company history.
Garmin generated $5.89 billion in fiscal 2024 revenue, up 14%. Fitness leads at 29% of revenue, $1.71 billion, up 16%. Outdoor adds 24%. Aviation contributes 19% at $1.12 billion. Marine and auto OEM split the remaining 28%.
The operating margin of 27.5% is above peers in consumer electronics and comparable to premium software companies, reflecting the pricing power Garmin commands in niches where it faces no direct competitor. Free cash flow of $1.4 billion funds the dividend and ongoing R&D without leverage.
Garmin's primary moat is 5-segment diversification. No single market owns Garmin. Fitness, outdoor, aviation, marine, and auto OEM each have different customer bases and competitive dynamics, so when one market faces disruption, the others absorb the impact.
Aviation is the second moat. Garmin holds 70+% share in general aviation cockpit navigation, a market where FAA certification creates a multi-year barrier to entry. Once an aircraft owner installs Garmin avionics, the system stays for the life of the aircraft.
Garmin has delivered 8 consecutive annual dividend increases. Total annual dividends paid approach $650 million. The dividend growth from $2.04 in 2015 to $3 in 2024 is backed by consistent free cash flow generation.
Garmin's dividend coverage is supported by $1.4 billion in free cash flow against $650 million in annual dividends, a coverage ratio of more than 2x. The company carries no net debt, making the dividend one of the most conservatively funded in consumer electronics.
On the competitive radar, Garmin leads on 5-segment diversification at 95 and marine navigation at 90. Mobileye leads on auto OEM design wins at 90, the specialist benchmark. Apple leads on fitness platform retention at 88, reflecting the stickiness of Apple Watch's health ecosystem.
Honeywell scores 80 on aviation market dominance, the closest competitor in that segment, but scores near 0 in outdoor wearables and marine. The Garmin advantage is that no single competitor can challenge all 5 segments simultaneously.
Garmin operates in more than 100 countries. More than 7,000 aviation unit types carry FAA certification. The Connect IQ app ecosystem hosts 5,000-plus third-party applications. Garmin holds over 1,000 active patents. 19,000 employees support 5 product segments globally.
The marine segment extends Garmin's network into chart plotter systems that integrate fish finders, autopilots, and radar, creating a connected boating platform where switching away means replacing an entire system of interoperable hardware, not just a navigation device.
Clifton Pemble holds a BS in electrical engineering from the University of Kansas. He joined Garmin as an engineer in 1989, the founding year, and has spent his entire career at one company, advancing from individual engineer to VP of engineering by 2002.
Pemble served as president and COO from 2007 before becoming president and CEO in 2013. His 35-year tenure at Garmin, beginning before the company had a single product on the market, gives him operational depth across every product generation and every segment transition. Garmin survived the smartphone GPS apocalypse that killed Magellan and TomTom's consumer businesses by becoming the company for the pursuits where smartphones fail: aviation, marine, backcountry navigation, and endurance sports, where a phone dies or loses signal exactly when you need it most.
The five-segment diversification is the key to understanding why Garmin keeps defying its own expected obsolescence. When consumer GPS for cars collapsed, aviation and outdoor absorbed the revenue. When fitness trackers faced Fitbit and Apple, Garmin pushed upmarket to endurance athletes who pay $800 for a watch. Each segment is small enough that no competitor dominates all five simultaneously. Welcome back to Charged Alpha. I am Hudson with Lana. Today we break down Garmin Q1 2026, ticker GRMN.
Garmin traces its roots to GPS technology for aviation, founded in 1989. Today it's a five-segment hardware powerhouse spanning fitness, outdoor, marine, aviation, and automotive.
Shares at 242.66, market cap 51 billion, debt-free with 4.3 billion cash.
Q1 beat on both lines, revenue up 14%, EPS up 29%. Let us get into it.
Garmin operates from dual headquarters in Olathe, Kansas and Schaffhausen, Switzerland. Clifton Pemble has served as CEO since 2013, succeeding co-founder Min Kao.
Co-founders Gary Burrell and Min Kao built the company around aviation GPS, then expanded into consumer wearables, marine electronics, and outdoor adventure devices over 3 decades.
The 5 reportable segments are fitness, outdoor, marine, aviation, and auto OEM. Each targets distinct end markets with proprietary hardware, sensors, and embedded software ecosystems.
Garmin's moat blends vertical integration, brand loyalty, and a sticky connect platform with millions of registered users and growing subscriber activity. The company designs, manufactures, and distributes globally with consistent operating discipline.
Headline numbers. Revenue came in at $1.750 billion, up 14% year over year, beating consensus of $1.721 billion.
Pro forma EPS landed at 208, beating the 182 estimate by 14%. GAAP EPS was 209, up 29% year over year.
Gross margin printed at 59.4%, reflecting favorable product mix and strong pricing power across all 5 segments. Operating margin reached 24.6% on disciplined cost management and fixed cost leverage from the revenue beat.
Operating income came in at $432 million, up 30% year over year. That's leverage flowing through from revenue growth into bottom line expansion.
Free cash flow generated $469 million for the quarter. Combined with the $4.3 billion cash hoard, optionality remains exceptional for capital deployment.
Segment by segment. Fitness exploded 42% to $547 million, now Garmin's largest segment, driven by advanced wearables and cycling product cycles.
Outdoor declined 5% to $418 million. This was the lone soft spot, reflecting tougher comparisons against last year's adventure launch cycle.
Marine grew 11% to $355 million. Boat builder demand and chart plotter refreshes continue supporting Garmin's leadership position in recreational marine electronics globally.
Aviation jumped 18% to $264 million, helped by aftermarket strength and OEM partnerships. This high-margin segment continues quietly compounding above the corporate average.
Auto OEM grew 1% to $170 million. The infotainment ramp continues, though year-over-year comparisons have flattened as the segment scales toward maturity.
Bottom line, 4 of 5 segments grew, 3 at double digits. Fitness alone added roughly $162 million in incremental quarterly revenue versus prior year.
Valuation check. GRMN trades at 30.9 times trailing earnings and roughly 26 times forward, with a forward EPS projection of $9.35 for FY 2026. That estimate assumes guidance holds and fitness segment momentum carries into the back half, which is now the key assumption for the valuation to remain supported.
Price to book sits at 5.95 times. For a debt-free hardware company generating high 20% operating margins, that's a reasonable premium.
The dividend yield is 1.5%, modest but supported by enormous free cash flow generation and zero financial leverage on the balance sheet.
Forward PE of 26 is elevated versus historical Garmin averages, but justified if fitness segment momentum sustains and aviation continues its mid-teens growth trajectory. Garmin has historically beaten initial guidance, so the forward number may prove conservative as the year progresses.
PEG ratio implications. With EPS growing 29% and forward PE at 26, the growth-adjusted multiple looks reasonable, assuming any continued momentum holds.
Cash represents about 8% of market cap. Strip that out, and the enterprise value multiple compresses meaningfully versus the headline PE figure investors typically cite.
Margins are the valuation anchor. 59% gross and 24% operating margins are exceptional for hardware. Software-like profitability with a tangible product moat.
Return on equity remains strong given the asset-light segments and pricing power. Capital intensity is moderate, freeing cash for buybacks, dividends, and tuck-in acquisitions. With zero debt and a growing cash pile, the balance sheet gives management more options than almost any comparable hardware company.
Comparing against historical multiples, Garmin's premium reflects diversification across 5 end markets. No single segment exceeds 32% of total quarterly revenue mix.
Bottom line on valuation, you're paying a premium, but for quality. Beat and raise potential and fitness momentum could keep the multiple supported through fiscal year end.
Why now? Fitness segment is firing on all cylinders, up 42%. Advanced wearables like the Fenix and Forerunner lines are taking share from competitors. The running, cycling, and multisport communities are expanding globally and skewing toward premium devices.
Aviation strength continues quietly compounding. 18% growth in a high-margin segment provides earnings ballast even when consumer-exposed segments face cyclical headwinds or tougher comps. The aftermarket avionics cycle has historically been resilient through broader macro downturns, giving the segment durability that consumer hardware lacks.
Marine 11% growth signals healthy boat builder demand and recreational spending resilience. Garmin's chart plotter ecosystem retains strong attach rates across new vessel installations.
Management reaffirmed full-year guidance of $7.9 billion in revenue and $9.35 EPS. Confidence in the back half remains intact despite outdoor softness.
The Fortress balance sheet allows opportunistic capital deployment. Tuck-in acquisitions, sustained dividend growth, and buybacks remain feasible without stressing the company's financial flexibility. No competitor combines zero debt and $4 billion in cash at Garmin's scale, making the optionality genuinely unique in the peer group.
Catalysts ahead. The Fenix 8 launch cycle is still ramping, with international rollouts and accessory attach rates supporting fitness segment growth into the second half. Channel inventory at major retailers remains lean, suggesting healthy underlying consumer demand without meaningful destocking risk near term.
Aviation aftermarket cycles tend to compound. Avionics retrofits, certified upgrades, and OEM partnerships with general aviation manufacturers offer multi-quarter visibility into recurring revenue streams.
Marine season ramps in Q2 and Q3. Boat builder orders, chart plotter refreshes, and trolling motor product extensions could push the segment toward continued double-digit growth quarterly. Garmin's Panoptix LiveScope sonar has become a must-have platform for competitive anglers and recreational boaters across North America.
Auto OEM win announcements with European premium manufacturers represent a longer-dated catalyst. Each design win compounds revenue over multi-year vehicle production life cycles in infotainment systems.
Capital return. With $4.3 billion in cash, accelerated buyback announcements or special dividends remain plausible if management opts to deploy excess balance sheet cash. The dividend has grown every year since initiation, and that streak is not at risk given current free cash flow generation.
Outdoor segment recovery is the wild card. Easier comparisons in the second half, plus new Adventure Watch refreshes, could swing the segment back to positive growth territory.
Risks. Outdoor segment declined 5%. If softness persists into the second half, full-year guidance could face downward pressure despite fitness segment strength offsetting elsewhere. Fenix cycle comps get harder in Q3 and Q4 if the Adventure Watch lineup is not refreshed.
Consumer discretionary exposure remains real. Fitness, outdoor, and marine all depend on healthy consumer spending. A macro downturn would compress unit demand across these three segments.
Currency exposure matters. Garmin generates significant international revenue. A stronger dollar pressures reported growth and translated margins, even when underlying constant currency demand remains broadly healthy.
Component cost inflation could pressure gross margins. 59% is exceptional, but historically peakish. Mix shifts toward lower margin segments may reset the corporate gross margin trajectory. Taiwan source components in particular carry supply chain concentration risk that management monitors closely.
Competitive intensity in wearables is rising. Apple, Samsung, and emerging entrants all push deeper into health-focused wrist devices, potentially capping fitness segment unit growth medium term. Apple Watch remains the dominant platform in Western markets and is expanding its health sensor capabilities.
Valuation itself is a risk. Forward PE near 26 leaves little room for execution missteps. Any guidance cut or margin compression would invite multiple compression.
Auto OEM growth flatlining at 1% shows maturation. If design win cadence slows, that segment may transition from growth to stable, reducing the diversification narrative slightly.
Competitive landscape. Garmin faces rivals including AAPL, Honeywell, and TRMB across different segments. Apple in wearables, Honeywell in aviation, and Trimble in GPS precision applications. Each operates in a different primary market, which is why Garmin rarely loses a customer to one competitor across all five segments.
Analyst sentiment is mixed but lean positive. 4 buys, 2 holds, 1 sell. The average price target sits at 256, implying roughly 5% upside.
The bull case rests on fitness momentum, sustaining, aviation compounding, and management deploying the cash hoard accretively into buybacks or selective bolt-on technology acquisitions globally.
Bears point to consumer cyclicality, currency headwinds, and elevated valuation. They argue the multiple has expanded too quickly relative to long-term sustainable revenue and earnings growth. A single guidance miss at a forward PE of 26 would likely trigger a meaningful derating that erases months of prior outperformance.
Versus pure-play wearables, Garmin's diversification is the differentiator. Aviation and marine provide ballast that Apple wrist-only competitors simply cannot match in product breadth.
Versus aviation-only peers like Honeywell, Garmin's consumer segments add growth optionality. The blend creates a unique profile not easily replicated by any single competitor today. Honeywell's avionics division is formidable but lacks the retail brand recognition that drives Garmin's consumer flywheel across wearables, outdoor, and marine.
Bottom line, GRMN's Q1 was a clean beat and reaffirm with broad-based segment strength. The outdoor weakness deserves monitoring, but the overall thesis remains intact for now.
Quick recap. Revenue beat at $1.75 billion, EPS beat at $2.08, fitness up 42%, full-year guidance reaffirmed at $9.35. The result was broad-based, with 4 of 5 segments growing year over year and only outdoor facing a transient headwind.
The setup into the back half of 2026 looks constructive. Outdoor comps ease, auto OEM ramps, and the balance sheet gives management options. Watch for guidance raises and fitness segment sustainability through the peak of the cycling and running season.
Charged Alpha is for informational and entertainment purposes only. Nothing on this show is financial advice. We are not financial advisors. All investing involves risk, including the possible loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a licensed professional before making any investment decisions. Charged Alpha.
we do? That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.